Thank you very much. Hi, everybody. Bill West, as Dee alluded to, I spent a career in banking, so I've trained a lot of people on valuations, on credit analysis, on things that go into valuations, my valuation system that I'm going to show you a little bit of here today. I'm going to show you a lot today, a little bit of the valuation system. It literally came out of my banking roots and doing loan loss reserve calculations for banks, for financial institutions. So it's a very reliable approach, and we will walk through that now. So, um, figure out how to. There we go. Okay, enough about me. Two associations that I'm very active with. A lot of data comes from just a lot of my work goes through these two organizations. International Business Brokers Association is a large, primarily nationwide, but it is an international. There's definitely international members, but it's certainly a national organization for business brokers here. And then Business Brokers of Florida, we're very fortunate to have a wonderful business brokerage association here in Florida. We cooperate together. Works very much like you would think of in the residential real estate community, where you've got other people selling other businesses for each other as well as their own. But just great organizations. A lot of the data that you'll see in here comes out of each of those. We do IBBA does a survey quarterly, but annually is the data that I have in here for you. That's real live, real world data. Um, so exit planning. Why do I have an exit planning slide here? You have accidentally snuck into an exit planning conversation. This is the beginning of your exit planning journey. Like the bottom line says, that doesn't mean you're ready to leave. It means you're ready to work on your business. So I have long said those 32 years that you mentioned. 32 years ago, I was saying begin with the end in mind, right? So what's your plan? What are you thinking about? There's a book out, Built to Sell. It's a good book and it's a right book. I would change the title to Built with the Option to Sell, right? You want to build yourself into the position to where you have options if you want to sell, if you want to stay, if you want to do whatever it is with your business. But with that, some exits are unexpected. Some things happen, life happens, right? So the best exits are intentional, where you've created the options, you've created different paths for yourselves earlier. The worst are when they surprise you and they sneak up on you. So why do business owners decide to sell? Many decide to sell for retirement. There's burnout, lifestyle changes, health or family needs, no succession plans. You don't have anybody to take over the business. You have to sell it externally. Market timing can definitely have an impact. I've seen Florida's market come light on fire since COVID. It's a different environment here in Florida through and since COVID. It peaked right after COVID, but it's a very strong, very changed environment from before and after. Desire to de-risk, definitely you get everything. Many business owners, I see business owners that I started off with 30 years ago that they're still living in the same house they were living in 30 years ago. They invest everything back into the business, and the business is what's growing, and that's where their wealth is. So to access that wealth, then they feel that they want to sell. And there's growth plateaus, and a lot of times those kind of come together. People get comfortable with where they are in the business. It needs new leadership to take it to a next level. So why specifically do people tend to sell their business? And it's retirement. That's the if you look across here, so this is different business size categories. Under $500,000, the largest up there at 5 to 50 million. And you can see across the board, it is retirement is the pink red line there for you. So retirement is the reason why people want to look. So retirement is predictable, and you would think people would plan for it, but they don't. They tend to it comes up. It's you're busy working on your business, I think is the bottom line to it. It's hard to do everything, but you need to pull back, step back, and make sure that you're working on your business to make it successful. There's processes that you can do to the things that you will do right now today to make your business successful, make it sellable, are the same things you would do to make it successful, right? It's just good business operating procedures and things that we're going to talk a little bit about. So exit planning, how many, so if this is a retirement is the issue and it's predictable, how many business owners tend to do do any kind of exit planning. And you can see here, it's basically it's none is across the board. Largest businesses, you can see the larger businesses do more planning than the smaller ones, and that might be some of the reason for their success. But in general, there's very, very little exit planning. So you've already got a head start, right? So right now, that's why these exit planning slides are in. I'm going to show you how the valuation sits at the center of this process. We're going to talk a little bit more about businesses first. So this is the market segments that we work within. I would say there's another segment in here, which is really where I work at, and that's the SBA market. With my banking background, and as we'll discuss in here, I mean, it has to be a financeable sale for it to be for you to get the full value, right? So within the SBA realm, about a $500,000 is about the minimum that you can make a functional, feasible business that can provide income for a family to survive off of. And then up to that 5 million is where the SBA limit is. You can really go above that 5 million. So maybe even 10 million, definitely 7.5 million. The 500,000 to $7.5 million is what I would call the SBA world, which is where most business acquisition and sale transactions occur and how they occur. So what sells by these sectors, right? So under $500,000, it tends to be it's less capital intensive and more people intensive. So construction, engineering, it's brain power, personal services, doing things for people, business services, again, doing things for people. Business services can grow into larger businesses as construction. And then you see consumer goods start to, so that's some of the mom and pop retail type locations that are falling into that 1 million to $2 million range. And then you get bigger, you get into the more capital intensive type businesses, $2 million. You start seeing some manufacturing firms. Usually they're 3 or 5 or larger than that, but you do start to see them in the $2 million range. Construction engineering, typically with equipment and operations and things that go along with it. Wholesale distribution begins to make its appearance. Manufacturing, as I said, gets to be an even larger portion of the pie as we grow. So that's really the lower middle market sectors. The advantages right now, the market itself, it's been, as I started to describe, since COVID in Florida especially, it has been a very strong seller's market. If you have a good, solid business, you are in an enviable position right now. You certainly you have options. Bank financing is readily available. It's been readily available even through COVID. There might have been a little bump. There were definitely bumps when they were distracted with PPP lending and those kind of things. But SBA lending is very, very much available. Other commercial lending is available. Commercial real estate lending is available. The banks are eager and happy to lend now. You do need to, I'd say, in the business acquisition piece of it, you need to be very selective with the banks that you're working with. There are many of the Main Street banks, the ones the retail banks with bank branches, they do a lot more than acquisition financing. So they're not specialists in acquisition financing necessarily. They might be very good at SBA, but when it comes to selling your business, you want to make sure you have a bank that you're working with that is very good at acquisition financing. And there are SBA lenders that's all they do out there is SBA financing for acquisitions, and they are exceptional at it. Larger operations, that's definitely the trend is the bigger, the better, the more buyers you're going to have. And I'll show you that in some of the data we have coming up. All right, so deal breakers. Why? What happens? What can go wrong in a business in a business sale transaction? And this is why we're here, right? So the number one reason business transactions kind of fall apart is the valuation, right? So people there's on one side or the other side or both sides have disagreements about it. So you need to have a real factual approach to the value. It is very much where the question starts, where the whole idea, right? So it's a pivot point for the entire transaction. It's a critical pivot point. But I'd say these first 3 items are something that I handle very, very clearly in our approach here. And it's over half of the reasons why deals fall apart. If you're really thorough and really diligent up front, and you use this kind of process, you can eliminate a lot of it. You can get rid of the riffraff, and you know that you're dealing with a qualified buyer. The business is qualified. You put all those pieces together, and then you have a much higher success for a transition and a sale. So this is how I look at it. We look at businesses as a business owner has created something successful, and now it's time to retire or to do something else. And he has the success, and it's his reputation, her reputation, the family's reputation that's built up into this business with employees, with customers, with vendors. There's a lot of people that are expecting things out of you. So you may not be of a mind to just sell to a third party and to see what happens, but sometimes that's just the case. Frequently, that's what you need to have happen. If you haven't done a good job of transition planning, if you haven't done a good job of succession planning, if you don't have anybody on staff that can take over the business from you, then you're going to be into a third party sale. And again, so that's looking and qualifying those individuals. What I also have a passion for is it's internal sales. So it's key players. Just closed one 2 weeks ago now. I guess it's been lovely couple, husband and wife that were already in the business, operating a business. The owner had serious medical issues that kind of came up, and we were able to value and then create a plan, get them the SBA financing and everything they needed to perform that key man buyout. So now both the seller is happy. He says he had to call in. He had to call in for permission to get time off for the very first time right after Christmas. He wanted the next day off just so he had the opportunity to call in and ask for a day off for the first time in his life was cute. And then ESOPs, SBA ESOP. The SBA made some changes to the SBA SOP a few years ago that made ESOPs possible for SBA sized businesses. So if you're a $5 million business, if you got $500,000 in revenue and you've built the proper team around you, an ESOP is an excellent solution for that. And I may have jumped my next slide a little bit, but a third party sale. So it's a buyer outside your walls. It's not somebody internal. It's going to be a stranger. You've got to go through an NDA process. You've got to go through a process of knowing exactly who they are, knowing that you can trust them before you go sharing a lot of information. You're going to transfer that control to them, and then it's going to be their business. They're going to rename it, do whatever they want to do, need to do with that business they feel to execute on their plan. Um, and then, as I said, almost everything I do is SBA related. There's some seller there's reasons for seller notes, both for tax strategy and for if it's not an SBA financeable transaction, then to sell the business, you might want to play a role as the bank there to be able to get full value for it. But generally, across the board here, these are SBA frameworks. So key man, so I don't have a better name for it. It's key man. It means individuals, people within the business that are buying it. So it's trusted insiders in the business. Frequently, it's 100% cash at closing. There might be a seller note sometimes. You've got a lot of freedom to structure. You've got a lot of familiarity with the business. There's a lot of trust in these already. So it's definitely a good way to go. It's good for the community afterwards. It's good for the employees. It's good for the sellers. So I love that. And then the ESOP program, it's a wow. If you can qualify for an ESOP, I mean, this is very much the anti-PE. Private equity firms are in the market now, buying up businesses, and they don't always do the right thing for them. With an ESOP, it's your team buying it. They're getting the benefit. They're buying it from you at full market value. There's tax advantages for you, tax advantages for the business. It's just a wonderful tool to be able to offer to these Main Street businesses now, lower middle market. So business valuation for decision making. I've got three topics on here. Selling or acquiring a business is an obvious one. Attracting investors, you see some of that, especially in some of the higher growth or the technical type businesses. Estate planning and succession, and then just in general is so from my banking knowledge, my credit analysis, my background, just the spreading of the financials, the recasting of the financials that you do, looking at them in this format, it gives you clues to your businesses. I'm frequently able to give really valuable advice to business owners just by doing a valuation for them and looking at and showing them their numbers in a way that they haven't seen them before. Okay, so when you value a business, what are the how do you go about valuing a business? And in business, in any valuation, in appraisals, there's three approaches to that. It's the market approach, the income approach, and the asset approach. So these are the different approaches that you can use. Uh, there are reasons to use each of them and reasons to not use each of them. And when you are selling a business, the only one of these approaches that matters is the market approach. Income approach, so I think I've got that on another slide. So market approach, income approach, asset approach. The market approach is you're comparing it to other businesses. Let me go ahead and flip my slide. Um, Market approach, you're comparing it to other businesses. For the income approach, it's a discounted cash flow analysis. It does not typically work in the small business realm. They're just the cash flows aren't predictable. One of the most predictable cash flows in a small business would be something like a preschool, a child care center that has predictable enrollment, predictable expenses, and even with that, it's really difficult to use a discounted cash flow approach to value a business and come up with the right number. Assessing asset values. This is what your banker wants to do, right? So he wants to look at your asset values, ignore the goodwill. Goodwill is a big piece of your business. The asset values is really if you're in a liquidating type, if you're going to sell the assets without the business that goes along with it, without the benefit of that operating company that goes along with it, what would those assets be worth? And frequently it's pennies on the dollar for what you even paid for them, much less what you could get with goodwill and everything out of an operating business. Now, let's stick here. So back to business valuation, steps in the valuation process. So um, you're going to gather the financial data. I rely very heavily on tax return data to support my analysis. I'm going to show you a little bit of it in a second here. But I rely on the tax returns. I've been through 30 plus years in banking, looking at financial statements, looking at and comparing them to tax returns. Um, you'll get a set that are like it. If you get interim financials, but the tax returns very rarely going to look like what the interim financials look like. There's depreciation, there's owners out there's things that are just left off of there or done that are corrected at the end of the year to produce the final financials. So I look at them for information. I'm looking at top line, what's revenue, what are cost of goods, those kind of things. But there's a lot of information that's going to be missing in an interim financial statement. If you have good CPA prepared or reviewed or whatever financial statements at the end of the year, annually or quarterly, if you can do it quarterly, most people tend to stick with some kind of annual requirements. They would do a reviewed financial statement for a bonding or something like that. But the financial statements are a key piece of gathering the information. So I get tax returns, financial statements, and I usually get like accounts receivable, aging reports, some other information on the business, gathering that financial data. What I'm really mining, though, as I said, is the tax returns. I know that that's very reliable information. It also compares directly to my database as I show you my approach and how I build it. You want a direct comparison to that. So using that tax return data is by far the most reliable source of information for you and what you should rely on as a buyer or as a seller. Normalizing the income, I'm going to show you that as well in our details. So normalizing the income, spreading the income, you've heard me say it. Recasting is another term for normalizing the income. And what you're taking it and you're making it stable. So there's um, two outcomes, EBITDA or seller's discretionary earnings that we use to calculate the values. Again, I'll show you that as we get further down, but they have different reasons for using them. So normalizing the income, getting down to that approach. With either approach, you're adding back things like depreciation, interest. Those things are being added back. With the seller's discretionary earning, I'll show you we're also adding back some. It's the seller's benefits that they're receiving out of the company that you're adding back to include in there. So identifying comparable companies is critical for the market approach. Once you've got your normalized income, to compare it to the right companies, like companies is the right way, as I said, to get a value. Discounted cash flow, you could do it from that method, but you're typically in the wrong with that. end up with the wrong outcome. Assessing asset values is a completely different approach. You're taking inventory, you're looking and seeing what they got, and then you're adding up the numbers that those would sell for on the market. Not what we're going to be discussing today. And we're not going to discuss discounted cash flow either. So evaluation. This is the start. Value and pricing your business appropriately. As we said, that was the number one reason, and then the second two issues that business sales fall apart can also be corrected by this method here. And it's just making sure it's a financeable transaction. So this is getting a little old. It's a year and a half old on it, but I really like this one because it's got some of the add backs and things. So I think I can really show you the dramatic differences. So this is it's a construction material company. So they would supply materials to contractors, finished materials to contractors that they would then use to construct buildings. 2.8 million dollars, a little under $3 million in revenue kind of going across. And you can see the ordinary business income loss, which is what you're going to use a multiple on, right? So you can see a $500,000 loss. That's a little bit scary. Only a $440,000 income. Not that great. Okay. 173, $200,000 in income. I lost my page. $214,000 in income. Okay, that's reasonable. What is the real benefit to this owner? And that's what I want to show you. So this is the income statement. This is spreading the income statement, putting them out here. I've got factual tax return data. You can see my accrual statement over there for like the first quarter of the year that I used, or first third of the year, I guess, that I used just to compare, just to see if things were going steady, see how things were looking for the business. But really what I'm relying on is that 23, 22, and 21 as you go across to the left. Those are the numbers. All right, so what do we do with them? This method is that what I'm doing in this process is just calculating seller's discretionary earnings. So it's all the calculations from that. So there was a one-time gain that really wasn't a gain. So we take that, it wasn't going to recur, right? So we take that out of there. It's not going to recur, not something a future owner is going to look forward to. Taking it out, other income is typically non-recurring. You can see it only happened 1 year here. So we're eliminating that. The officer's compensation, we're putting that back into income. There was a little bit of bad debt. Rent kind of goes across. Interest expense. Interest expense is always an add back. Depreciation is non-cash. Interest expense goes away because the new seller is going to have their own cash flow, their own capital structure, the financing capitalization structure that they're going to use for the business. Depreciation goes away because it's not a cash expense. And then there's other deductions. So this is, if you recall, so 2021 was his horrible year, it looked like, on his tax return. What happened in 2021, though, was he had inventory. So they make a concrete product that's then installed in a building. It's a unique, every mold he builds is unique. He was capitalizing them and keeping them on the books. So we took a one-time write-off, and a bank is going to accept this. You're going to show them, this was a one-time write-off. It was for obsolete. We had it as capital equipment. It really should have been part of the cost of goods and should have been written off a long time ago. You can also add back his golf club membership, doing well enough to have that. And then somebody gave him a make me move check to make him move his business, and he had some relocation expenses that wouldn't recur. And then he brings his spouse into the business. So all of those are items that I can go back and add back into the business. I can realistically show a bank, this is how it is. So you can rely on my cash flow. They're going to do their own analysis. I'm not going to rely on my cash flow, but they can. It's going to match up, and we'll talk a little bit more about that too. All right, so this is the normalized cash flow. So this is the sum of these originals less these modifications to come out with this cash flow. As I said, I only calculated the seller's discretionary, so both of these are coming out the same. But you can see, instead of a $50,000, or no, it wasn't $50,000, it was a $500,000 loss, wasn't it? For $450,000 loss. Instead of a $450,000 loss in 2021, it was really a $200,000 owner benefit that the owner received. He had some, this is kind of a turnaround story. He thought he had a succession plan with his kids being in the business and thought they were going to take over the business, but he had to step back in himself, and that's where you see the growth of the improvement in the numbers and the net earnings numbers there for him. But that's really this is the meat. This is the real work of doing a business valuation is getting these numbers right, understanding the cash flow, and being able to clearly show that cash flow. So, what do confident founders do? This is just a maximizing value thing, kind of statement, but it definitely very much comes after those numbers. So if you have those numbers, you need to be able to give the numbers. You need to be able to back them up. I'm working on a transaction right now that the other broker represented numbers, and now I'm trying to drill down into them and to really understand them, and they don't match up to what he gave me. So we've got to rebuild, and then we've got to trust. But we will rebuild and see if it's something that we want to move forward with. But having clean, accurate financials, having it match up, understanding your value is critical. Documenting your operations, it's so much easier to document your operations right now. Right now we're doing a webinar. You do things all the time. Your people do things all the time. Have them do it in front of a webinar type, whether it's Zoom, have it do it on Zoom, record it on Otter AI, upload it into ChatGPT, and you can really easily create SOPs for all of your everything that you do. It's very easy to do. So documenting operations, it shows a lot about the business. It shows a lot about your ability to turn it over and how well it's run. And it's easy to do now. And you can look really good before everybody figures this out. Clear succession or leadership plan. If the better the business runs without you, the better off you are and the more value you've created. So having a clear leadership succession, having a team around you, all of those things, building those are very, very important to maximizing your value. Timely and transparent communication again. So it's like I said, keeping the buyer engaged in this one where we had the cash flow separate is a little bit of a challenge because can he trust them? Can we trust them? I believe we can trust them, but we've got to verify and we've got to get the numbers down. Realistic, defensible valuation, and that's exactly what we're talking about here, right? So it's making sure you have the facts and that you can talk from knowledge. So multipliers, you always hear about the multipliers. It's a three times, it's a whatever. It's why do multipliers matter? Because they help investors compare businesses. There are differences in businesses. There's a lot of similarities, commonalities in businesses, but there are differences as well in how they sell, how they perform. The cash flow on a preschool, it's going to demand a higher multiple just because of the predictability of it. Whereas something is less predictable, it's going to demand a lower multiple. But the multiples are how individual investors will compare independent businesses as they're making their investment. The type of multiple that you use or the type how you calculate that multiple, how you use the multiple differs by business. So if you have $1 million in EBITDA, you're likely a PE candidate, and EBITDA is likely how they're going to calculate the cash flow. If you're below $1 million in businesses, it's below $1 million in EBITDA, it's likely going to be an SBA finance transaction, and you're likely going to calculate it using a seller's discretionary earnings type model. The reason for that, so that and you always hear the EBITDA multiples higher, and frequently they are just because it's saying something about the business and the quality of business. But also in there is the owner add back for the owner salary. In the smaller transactions, the assumption is somebody's going to go in there. A buyer is going to manage the business and be the executive for that business. With an with a PE type transaction, it's a management team that they're going to want already in place or to build and to put into place. So it's just how they're looking at it. With the above $1 million, they're assuming all of the expenses, all of the salaries and everything are going to stay in place. With the below $1 million, the assumption is that the buyer is going to take over some of those responsibilities and get some of that benefit. Calculating multiples. How do you calculate the multiples? Seller discretionary earnings is what we're going to tackle first. The formula for seller discretionary earnings, it's net income plus your owner's compensation plus your add backs. Your add backs are so non-cash items like depreciation that we talked about before, Interest, there should be a comma in there after interest, but it's interest. It's any personal expenses that are reasonable that are run through the business. Keep them small. I've definitely seen a lot that you would never add back, but it's those personal expenses. Other non-recurring costs, like we said, we talked about the one-time write-off that really was not a cash expense. Sometimes you might have a property that you're leasing and you invest in it every 10 years, or you do some remodeling, whatever, you own it, you invest in it every 10 years, and you've had some improvements that you've made to it that aren't going to reoccur for a while. You would add those kind of improvements back as well. So to get to the business value, it's the multiple we were talking about, and the seller's discretionary earnings. Frequently, there's we'll talk about multiple a little bit, but a three times multiple, somewhere around a three time, it might be a two time, it might be a four time. Occasionally there's a five or a six times even. Has to be very, very good reasons for that, but frequently it's somewhere hovering around a four, a little bit over, a little bit under. The business, your type of business, the industry that you're in is really going to drive what that multiple is. But here in just a very simple example, assuming $250,000 of seller discretionary earnings, multiple of three, and then you've got a simple business value of $750,000. For EBITDA, it's net income plus interest plus taxes plus depreciation plus amortization, right? So the net income self-explanatory. Interest we've kind of talked about it's assuming that's going to be recapitalized or going to go away. There's going to be a new structure there somehow. Taxes are never included in the EBITDA calculation. Depreciation and amortization are also added back. Depreciation, you're used to seeing amortization as frequently if they've acquired another business. There might be amortization that they are also expensing that's non-cash. So an EBITDA multiple, it's the business value. It's EBITDA. The business value equals EBITDA times the multiple. So if that EBITDA was $200,000, we had a multiple of four, then that business is going to be worth $400,000. Very, very simple math. So typical transactions. This is what I want to show. This compares a couple of years. And what I want to show more than the trend of the comparison between the years is the trend in the multiple, right? So this is transaction size. This varies because of financial. It's these types of businesses are you're not going to have as good a quality with financials. You're going to have other things that are going on there. So this kind of variance is really a result of, I think, it being that sub piece of the market. But once you get into the $500,000, you can see the improvements in price between that, or improvements in multiples between the $500,000 to $1 million, the million to 2 million. You can see it continues to increase up, 2 million to 5 million. And then you get over to five, that's where you start to get some of these really higher multiples there. But definitely transaction size, as I said before, larger operations are preferred. Larger operations also tends to mean quality of operations. It kind of goes together. That's how you get bigger. So that size and that quality can demand a higher multiple. We are almost done. So value hack, take a vacation. This is absolutely my value hack. This is what I love to tell everybody. The best things you can do, create a business that can run without you. So the absolute best thing you can do in business is to teach it to run well, take a vacation. If you're able to take a successful vacation, people aren't calling you or you only get a few phone calls, the business is running, keep it going, do all the right things. There is an approach out there called EOS, Entrepreneurial Operating System, that I am a fan of that will help you to do exactly this, to help you take a vacation. So your chapter, it starts with the right number. That's what we were here to talk about today. I'm going to check the Q&A in a second. My contact information, you should be able to scan there, get to our website, get to me. But happy to help. I'm available for questions. You don't have to be a client. I am readily available to talk to any business owner or business buyer. And I think that was my last slide. So I am going to look for chat.
Actually, Bill, I just see I see a question from Howard Berkowitz. Actually, he asked a couple of questions, but the chats were there were no questions there.
Perfect.
One says, um, I have a few questions. How do you calculate goodwill value? That's the first question. Do you want me to continue?
Sure. No, if it's going to be a totally separate, yeah. So goodwill, it's literally the goodwill is. Let me get my slides to go back here. It is implied, is what it is, right? So if you're using your I'm not going to have a good example here for you in my analysis. I've got other pages in here. So if you're using the cash flow determinant, I didn't put any balance sheet information in here. So if you look at the balance sheets of these companies, this one happens to have real estate, happens to have some other hard stuff, but frequently, like a preschool, right? So I keep using the preschool example. There are very little assets. There's a table, some chairs, some build out. There's not a lot there. The cash flows are highly predictable. The multiple is going to be there, so the multiple is going to be calculated from the cash flow. So let's assume this is a preschool, not unrealistic. $400,000 in income from a preschool, and you had a four times multiple. So you're at four times four. You're at $1.6 million for this, and the business is probably going to have 200,000. If it had $500,000 worth of equipment and those kind of things that you could really latch on to, it would be a lot. So say it's $500,000, you've got a million one in goodwill. That's how you get to the goodwill.
Okay. And then the next question is, how is the X multiplier for each industry?
How is the X multiplier for each
I
industry?
bet it probably means how is it calculated?
How's it calculated? So that's the other, yeah, I didn't talk about that side of it. So my data, so the way that I came up with this valuation program was I was handed, went through a merger. On the other side of that merger, I was handed a portfolio of 984 commercial loan relationships that I had to calculate the loan loss reserve for. So I was able to take that this is our underwriting system, our credit analysis system. I was able to take it at the time, take an Access database and merge it with peer comp. So peer comps is the SBA. It's all of the SBA solds. That's where I know I've got very reliable information. It's been documented by a bank. It's tax return, reliable information. I mine that by SIC code and by NAICS code. Wow, I went back there. By NAICS code and by business quality to come up with the multiple that I will use. And like I said, it tends to be around that three. That's going to be if you had to pick a number, sometimes it's 3.19, sometimes it's 3.75, sometimes it's 2.15. But that three it really is a good rule of thumb that you can use. The more difficult piece is the slide that I'm showing you here, and getting to the proper income calculations, proper owner benefit calculations.
Okay, so and another question is, what are your thoughts on assets purchased versus whole company?
Depends on the circumstances. So buying a whole company, you're getting a benefit. That's I it's an odd world right now that I get to reside. It's a very cool world. So these I have young buyers and older sellers that are cashing out. Um, the younger buyer, you got to repeat the question for me. Sorry, I got kind of off on track.
Just wanted to know what your thoughts are on assets purchased versus whole company.
Okay. So asset purchase. So these young buyers are getting it was these owners when they were out there 30 years ago, they had to figure it out, right? So they had to go, it's how do I get my first customer? How do I make my first customer profitable? How do I put all these things together? When you're buying an operating company after it's been around for 3, 5 years, a lot of those things are kind of shaken out of it. So there's great benefit. If you can do the right analysis, there's tremendous benefit from buying an operating company as opposed to just assets. It's really difficult to start up an operation with whether you're um, if something's been there before and it wasn't working, it makes you ask why. If it hasn't been there before, you have to have a lot of confidence to put that kind of money into it. So I tend to favor, and maybe it's yeah, I definitely very much favor operating businesses.
Howard also asked, is the higher multiplier based on the higher profit margin?
Based on the business quality, it's based on buyer expectation. So it's the quality of the business, the quality of the earnings, quality of the contracts. There's a lot of things that you can do to improve. I think I'm hoping someone's on here. We've been talking about the contracts that they have and potentially putting in, giving up some business to get the better quality business and making sure that you're doing those things correctly. So you know. Contracting is a big way to improve value, and there's other things that you can do. But it's very much it's the quality of the business and the quality of those cash flows. How predictable are they? How reliable are they? There's industries that are cyclical. The construction businesses right now you can get uh, good top dollar for construction businesses, but we're in Florida and construction goes both ways. So I definitely caution buyers into construction businesses that are, hey, be prepared. You're not going to want to lever up as much. There's things you want to operate it differently. So
And I think this went along with that question. It was
Mhm.
Howard said buying assets, not liabilities. And then in parentheses, he says lawsuits, losses.
Yes. Okay. I thought he was going to kind of go down another because there's two types of sales too, right? So there's an asset sale and a stock sale. I'm seeing a lot more stock sales, but both of those are for operating businesses typically. Asset sale might not be an operating business, but typically, even with operating businesses, you're using asset sales. But yeah. If you have, even though they're called assets, right? You need the revenue that kind of goes along with them. You need the business. You need all of those pieces to it. And even when you're doing an asset sale in a transaction, that's what you're selling. You're selling the phone number, you're selling the business name, you're selling the goodwill.
Okay, so Larry Smith asked, can you explore two potential buyers simultaneously to entertain multiple offers?
Yes, absolutely. I like to narrow it down. You want to go forward with one, so you don't want to be stringing. But yeah, no, you can have many buyers at the same time and select the best one that fits you. You're this is obviously a seller question, so you're the seller and you're in control. You don't have to sell to anybody. You get to this is your business, your baby, and as far as a buyer goes, that's where I kind of lean back into the key man transactions and stuff. That's a preferred way to go for me. On the ESOPs to be able to sell to a pool of employees and to give them a benefit. That's a very much a preferred way to go.
Button. And again, thank you everyone and have a good rest of your day.
Thanks, everybody. Thank you, Dee.
Okay.